Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Okay, this week we're going to have a look at the ways that we can build a company valuation model. That's the lecture. On Wednesday workshop, I'm going to take you through the actual steps of analyzing the annual report of Woolies and have a look at how we are going to reorganize, divide, or cut into pieces of the accounting items into the items that we need for the valuation model. In this lecture, we're going to have a look at an overview of the company model using a completed valuation model by past student. And we're going to discuss the relevance for your assignment. And then generally, we're going to discuss how we're going to estimate ROIC, which is the key ratio we're going to look at in valuation. And also, we are going to discuss how we're going to estimate the parameters that we need for valuation to calculate ROIC and the importance of ROIC in valuation. If we still have time, then we have a look at other valuation models. One model is actually what I used in the past, many years ago as an analyst. And I'll give you some advice if you want to use these models. And another valuation model is from Damodaran. That's the academic valuation model. All of these are available on Wado, so if you're interested, you may have a look. But for our assignment and for this course, we focus on KGW model, which is more, in plain language, more difficult to use, but it's more thorough in terms of to help you to understand the performance of the company and to value the company as a business unit. Last week, I intentionally used a blank valuation model in lecture and workshop to show you, okay, this is what you are going to fill in the next few weeks. I didn't want to scare you away because it's really intimidating if you look at the examples from Wado of past examples. So when you have a look at these numbers, every single cell highlighted in yellow color needs your input. So you're going to read the annual report of the company. This is for ABC, Adelaide Brighton. It's a construction material company. So every single cell needs your input. That's P&L, balance sheet, and off-balance sheet items as well. And forecast drivers, you're going to see these important P&L items. Every single cell needs your input. So this is what we're going to do in terms of building a company model in a most straightforward or simple way. But actually, what makes the difference is the numbers you put in the forecast drivers spreadsheets, the revenue growth, the CapEx of the company, and working capital changes, and sometimes for some companies, the capital structure forecast. So that will make a difference in terms of its evaluation produced by Group 3 or Group 2 or Group 21 by different analysts. So what we mean building a company model is that we make inputs into the mechanical spreadsheets so that it will calculate a valuation for us. So in the model building itself, you don't really go to calculate NOPLAT. You don't calculate ROIC. You don't even calculate the valuation of the company. It's done by these spreadsheets. But we have to understand the mechanisms of how these numbers are put together. It looks like a complicated machine for you now, but after a few weeks, especially after week 7, hopefully most of you will be on top of these spreadsheets model, and you're going to know how this data, where they're going to feed, which spreadsheet, and where the analysis outcome will be shown in the spreadsheet model. So this is an overview of what we are going to achieve in your assignment and what we mean by building a company model. So throw a lot of inputs into the model itself and generate a valuation of the company. The accounting identities should be implicit in the cell links and formulas. What's the meaning of this? The accounting identities. Sorry, we have to switch from the lecture slides to the model itself frequently in this lecture. What's accounting identity? So when you have a look at the historical spreadsheet in the KGW model, okay, the top lines that require inputs are revenues, other operating revenues. And after inputting cost and depreciation, you're going to calculate EBITDA. So for valuation purpose, we understand that KGW model is designed in a way to capture the operating assets only. So we are focusing on the operating assets, operating revenue for, in this context, for the revenues, expenses, and we're going to strip out any non-operating assets and value them separately. Where? Here. These items are non-operating in nature. They are non-operating income, non-operating expense, non-operating costs. So this is the context of the model. If you see revenues, other operating revenues, and all of these items should be operating. So how can we do this? You got to read the P&L of Woolies, got to check every single note of revenue, no matter it's segment analysis, segment revenue reporting, or just notes on other revenues. You decide the number of operating revenue and input the number in row 7 or 8. So it depends on you. If you prefer one single number, you don't have to use 8. Just use operating revenue. Squeeze all of the operating revenues into one line from all the business units. So that's the accounting identity in the valuation model. If you look at other items, for instance, interest income. So we know that for valuation purpose, we would like to strip out any financing-related expenses or income from the operating income or cost. So here is where you're going to input the interest income or interest expense. So inherently, they are financing cash flow, and they are directly related to the financing activity of the company. For instance, the interest they pay, the interest they receive the cash flow, the interest expense. However, when you go to look at the annual report of Woolies, you're going to find the item of financing cost. No interest income or interest expense, financing cost. You need to go into the details of the notes of the financing cost, which is meant by accountants of financing cost. You have to take the interest income and interest expense number from the notes and input the income and expense over here. Only interest income and interest expense. There are other items included in financing cost, not necessarily interest income or interest expense. We're going to discuss that on Wednesday workshop. So here, what's the use of the interest income and interest expense? If you go to track how these numbers are going to be used in the valuation model, you will find out, okay, these will be associated with important company performance ratios and their financial gearing ratios, especially interest cover, is going to be calculated based on these numbers. They are not operating expense. So you're not going to deduct the interest expense from the NOPLAT or the NOPLAT calculation, or in other words, the ROIC calculation. That's the accounting identity of the items from the KGW model. So as I have suggested in previous workshop, you got to work from the company annual report, every single item, towards the KGW model, so that you're not going to miss anything from the accountant's financial statement, but use selectively of the items in the KGW model. It's at your discretion of using either one of these, operating revenue, or both of them, or for the cost items, if you prefer, you can squeeze all of the operating cost into one number and use either of these rows. They're going to be calculated, they're going to feed into the valuation model to calculate NOPLAT and give you some indications of the operating cost and profit margin of the company in the results spreadsheet. And you have other discretions as well. For instance, non-operating income, restructuring charges, and special items. They are all non-operating in nature. So if you prefer, and especially for some companies, the non-operating income expense is quite a small number. For instance, what's the revenue of Woolies, for instance? Has anyone read the annual reports, the P&L? What's the revenue of Woolies in the past financial year? Do you have some ideas, like, is it $1 billion, $50 billion, $20 billion? Yes. Is it $1 billion? No? No one has any sense of the revenue? Okay, I won't say it. You need to find out yourself. So for instance, when I examine the operating assets and non-operating assets, I found that, okay, there's only $50 million operating income from non-operating income from its non-operating assets, and compared with its $50 billion of revenue. This is trivial, very small number. If I go deeper, I found that, okay, within the portfolio of non-operating assets, there will be assets held for sale, disposed business units. There will be equity investment in other companies. There will be profit made by disposing several properties. So given this information and the context, I decide it's not worthwhile to separate the non-operating assets into several line items like the KGW model. So I decided to just squeeze all of the non-operating income and expenses into one number and input any one row here, either 16, 19, or 20. Any one of them will work for me because they are just non-operating income or expenses. So the KGW model is at your discretion. You may use some of the items you need. With the items you don't need, just leave it blank. But a warning is that do not try to insert a row here. I really like to find out the profit from the disposing properties, for instance, or I really want to have a look at the personnel expenses of the company. You do not insert a row on the spreadsheet. Instead, you go to rename one of these items here to be the same nature as the item you want to insert. For instance, the employee wages, that's the operating expense. If you want to separate that cost item, and you may just use one of these items here. Or if you're interested in any other profit or loss from discontinued operation, for instance, if you believe it's important for you to understand how the company has performed on this regard, you may just use this one of the special item or non-operating income, even restructuring charge. You might rename restructuring charges into profit loss from discontinued operations. So it's at your discretion. You may go to rename some of the items here, but do not insert any rows or columns as well. And do not touch anything in results spreadsheet and forecast drivers as well. You may only input data into the yellow highlighted cells. Do not disrupt the structure of the model. If you do have something like very complicated, you want to model the cost structure of the company, for instance, you may set up another spreadsheet over here or next to your historical accounts or forecast drivers so that the analysis of the cost structure can feed into one of the spreadsheets that's going to feed into the valuation onwards. Okay, so this is the general view of the valuation model and the guidelines how you might want to work with this model. For your assignment, you are expected to build such a model with inputs into the historical accounts, with inputs into the forecasted drivers like the revenue, the capex, and all the other important line items in the P&L and balance sheet, and sometimes some off-balance sheet items as well. So input into the model and generate some sensible forecast and generates a decent valuation model. And importantly, write up the notes of your model. To write some notes, you will see some notes in the historical data spreadsheet. I give you some notes on how these items should be used and some warnings that how you might use these line items or how you can select any item of balance sheet items to use. For you, if you like to put in any notes, you might overwrite anything I put in there so that all of the members within your group understand, okay, when they look at this special item, you put notes there. If you're the person who's doing the historical data inputs, everyone in the team will understand, okay, what's included in this special item. So everyone understands the numbers over here. You may overwrite my notes over here. If you still want to make notes on a particular number, for instance, depreciation, for instance, if the company got a large amount of depreciation as a result of capitalizing Software or customer management system, it's intangible assets. You want to highlight this depreciation or amortization of that intangible asset. You can click that number, right-click, and try to insert a comment. Here, you might input your comments on that particular number so that other people would understand what that number stands for. Alternatively, if you look at this forecast revenue spreadsheet, this is a very simple forecast model. I use this as an example of for its simplicity of structure. It's not a very good assignment. It might just get a pass grade overall. So you might have a column here to input your notes of how you are going to forecast the revenue growth in different business segments, and generate some graphs here and your ideas why you're going to forecast the company's revenue growth in this sector. That's a business unit. I think that's cement. Yes, cement business. To be flat, 1.54% every year in the next 7 years. So give your reasons in terms of notes. That's for the forecast model. It's particularly important for assignment 1 for me as the reviewer of your valuation model to understand your ideas of forecasting, your forecasting model, especially the top line items like revenue, the margin, and also the capex. These are the key items. Put in sufficient notes so that I understand. That's for very specific for assignment 1. I strongly suggest that all of the team members will have a meeting this week or next week. You have a meeting, you sit together and assign tasks and talk about yourself, your strength. Are you excellent working with Excel? Are you excellent analyzing the business? For instance, if you have background in marketing, business management, you are perfectly positioned to do the forecasting and also the writing up the reports in assignment 2 as well. So understand the strength of each of the members within your group. Then you assign the tasks. Hopefully, you do not leave the task, like entering the historical accounts, to 1 or 2 members. It's very important learning process. Don't leave it to 1 or 2 members of the group. It's not really fair for the person who's going to just write up the report. Some people may say, okay, I really have a very tight schedule in the coming semester. I got this competition for the university. I have CFA exam. I have a lot of things. I just want to write the report. This is not a very smart thing to do. So assign tasks among the members. You have 10 years of data to enter. So 5 or 6 members, at least one person should be responsible for entering 2 years of data into the historical accounts. So everyone should be involved in every stage of your model. When you assign the tasks, and then you go to work on your tasks, reading the company annual report, understanding the business, understanding the performance of the company, at the same time, have regular meetings so that you can exchange ideas, so that you can correct the misunderstanding of some concepts. This communication is critical for efficiency, efficiency-wise. Otherwise, if you just work on your own without any communication and you just put a number into the model, and you probably will end up inconsistent historical accounts. For instance, some people may classify every non-operating asset into one item. Others will prefer separating them into restructuring charges, extraordinary items, special items, and so you will see the historical accounts inconsistent. That will lead to more severe problems when you do your model diagnosis. When you calculate the ROIC or NOPLAT or other ratios, performance ratios you want to analyze further, they may be inconsistent. So talk to each other within your group, and there must be a project manager who's overseeing the whole process and coordinating the work of everyone. The KGW model does provide us the mechanics of inputting parameters, inputting the forecast into the model. It does produce the important ratios, performance analysis for valuation, but it does not do the forecasting for yourself. So in the forecasting spreadsheet, you need a number for the revenue growth if you're going to forecast that instead of margin, for instance. So this is not done by the model itself. That's how you're going to differentiate yourself from other analysts in the market and from other analysts in the class. So that's what the model cannot do for you. You need to understand the business, come up with a revenue growth in the next 5 years, and the key driver forecast for the further 10 years, and the parameter forecast for the continuing value estimate. And you're going to, you have to decide, are you going to run your valuation or business analysis by just one single big business unit or by segments? It's important at the early stage of the model building in the sense that for most listed companies, they have several business units. They are different in nature in terms of the competitiveness in their particular very specific business units. And they are different in terms of the profit margin, for instance, and capital requirement. So all of these characteristics of business units are different. Maybe it's better to forecast by business units, or sometimes it's better to forecast by geographic business units. It depends on the company and data availability. Let's have a look at an example from data analysis. This is a very useful tool for us to understand some general performance or ratios of listed companies from data analysis. So Macquarie Group, it's actually Macquarie, it used to be Macquarie Bank. It's investment bank. So it got its business units. In banking and financial services, commodities, global markets, that's probably trading, corporate and asset finance. They provide loans to corporations as well. Macquarie Asset Management, so asset management services for investors and superannuation funds, Macquarie Capital as well. So they operate in these different business units. You might wonder, for Macquarie, it's called Macquarie Group. I didn't change it on the slides because if I say I write Macquarie Group, you don't know what this company is. Because there are several other companies under the name Macquarie. So for an investment bank, if you look at its beta, 1.85, that's an estimate by Morningstar analyst. And we know the industry is 1.1. Why is it so low? What's the industry of Macquarie? It's financial service. If you look at the financial service of Australian companies, they are just the big banks, all of the 4 big banks, and Macquarie Bank. And a few other small financial service providers, either like funds management or investment banking or the insurance companies. So if you look at the industry beta, it's dominated by the big 4 banks. So that's why it's quite low. If you look at the company beta, we just take it as quick and dirty estimate. We don't think that's correct. You're going to estimate your own beta for Woolies later on. So 1.85, that means the company is very risky operation. If we look at the financial data, especially ratios, we just focus on the performance ratios like the EBITDA margin. Sometimes it's negative, 2%, 12%, sometimes 21%, 39%. Okay. Now we have some very general understanding of the business of Macquarie Group. It's highly risky industry, and it got several business segments. If you look at the segments, the revenue breakdown sort of quite even, but you look at the return on asset, return on sales, they are quite different because the risk of these business units are quite different. So now you have the option of forecasting each of these business units for Macquarie, or you want to just forecast as a whole one single business unit. What's your choice? Am I going to forecast its margin, its ROIC for commodities and global markets? Are you going to do that? For that nature of business, it's extremely difficult to forecast its performance, the trading of commodities. We know we don't really know how the commodity market will go and how Macquarie is going to perform in that business segment. So when you try to forecast in separate business units, you probably will very likely to introduce more errors into your forecast model. So for Macquarie, we probably will prefer forecasting the company as a single business unit instead of several business units or several geographic business units. Now let's go back to Woolworths. I trust some groups have read through the annual reports, got some understanding of the business, and tell me what's your impression of the risk of the company. The market beta is 1, so what do you expect the beta of Woolies will be? Is it like 1.8 or 0.5? In what range? 1.5? Less than 1, by how much? Like 0.9 or 0.5? Okay, so you prefer a range between 1 and 0.5. Other suggestions? Given the business risk of Woolies, if the market is 1, okay, I do not give you the answer. You find out yourself. Ask yourself the risk of Woolies' business. And now think about the different business units of Woolies. They have food retailing service, and what else? Petrol, liquor, and what else? Insurance? It's very small. It's very small. Major business units. What else? It's been disposed. It's good to understand the historical accounts, but going forward, we probably will focus on the existing business units. What are the other business units? Hotel operation, and what else? Big W, yes. Okay, now let's consider the risks of the different business units of Woolies. Which one is the most important, contributing the highest number, highest percentage of revenue and profit? Retail, yes. Which retail? Food, liquor, hotel, or which segment? Food, yes. Australian food, very good. You did the reading. Australian food is the single largest business unit that's contributing to much of the revenue and profit. So that's the core of the value of Woolies. So consider this as our benchmark. This is a sort of level of risk. If you consider other business units of Woolies, like Big W, hotel, liquor, are they at the same or similar level of risk? No. Higher or lower? Higher risk? Higher risk. Okay. If we are on a budget, we have $1,000 for the whole family, and when we stand just in front of Woolies and Zara, we'll probably go into Woolies to stock up our fridge for the family for the next week instead of buying something from Zara, because Zara is discretionary retail. Not all retail industry are the same. So that's why Woolies and Coles, they're labeled as defensive stock, because they sell living necessities. Anyway, if our salary doesn't really pick up quickly with the general inflation, we still need to go to Woolies and Coles to get our milk, breakfast, cereal, and get our food. But with other things like liquor, hotel, and even the items from Big W, there's clothes, DVDs, these kind of discretionary items, we probably will leave them later until we can fill in our fridge, until we can pay our bills. So the risk of other business units is higher than the Australian food retailing. But the food retailing industry is facing very intense competition in the next 10 years. Okay, this is not done by the KGW model. It relies on your input into the model as represented by the revenue growth, the margin, that's numerical representation of the company's competitive advantage within the industry. If you look at the whole business, it's a portfolio. So with Woolies, what's your initial impression? Are you going to forecast the company as one single business unit or into several business units? What's your preference for now? Just get some ideas. You prefer forecasting as one business or into different segments? Geographical or business? Business, yes. There's some suggestion that forecasting Woolies in several different business units. You have very strong argument for that, because the risk and the kind of competition they're going to face in the retail industry will be quite different in food retailing and other segments of the retailing industry. And also, data availability sometimes will dictate your forecasting model. Do we have data for like profit margin for the business units? Do we have the profit margin of different business units? Is group 26 here? So you have read the annual reports. You have started working on the assignment. Do we have the business segment performance, profit margin? No, can't recall. That's okay. That's okay. Anyone else? Group 29? These are the two groups who came to my consultation. They have already started building their model. So that's okay. You find out yourself. See if there's data available in the annual report to help you to understand the profit margin and the revenue growth of different business units or geographic business units. So these are the choices you have to build your model for Woolies. I'll stop there and leave the rest of the work for you to complete. Oh, it's only slide 6. So the modeling is not it's not mathematics, first of all. It's not like you just throw some number in there and then you got a result. That's not valuation. It involves a lot of judgment, like your understanding of the business risk, understanding of the business operation efficiency and different characteristics of the business, and incorporate this understanding into forecasting how this company is going to factor in the coming 5 years, given the competitive dynamics in the industry. So one size does not fit all, that in the sense that the KGW model is a general model. It's designed to fit most of the companies, especially retail, cyclical companies, manufacturing companies. For some companies with huge amount of R&D, you will find it's not sufficient. For example, for startup pharmaceutical companies, they don't really have these sales, 0, and they have cost, huge cost numbers, and they have the huge number of R&D, and you probably need to modify the model for a little bit to accommodate the characteristics of the companies. So don't take the model as given. You might change the model, modify it, so that it's appropriate for the company you are doing your valuation. Dividing up the assets. So we understand that KGW model is designed to value the operating assets only. With the non-operating assets, you might find it's quite tricky and difficult to understand, but actually in the KGW model, it's only one raw number, just a forecast of non-operating assets. So given that if you do understand the business of Woolies, you will find the non-operating assets are very small number relative to its core business, its core operating assets. So you might want to forecast a flat number for the non-operating assets for simplicity, because it's not worthwhile to delve too deep into forecasting the non-operating assets. That's for the case of Woolies. In the future, you probably will have to value a company, for example, merger acquisition target, as a member company of a large business group. So with these kind of companies, they have very complex ownership structure, cross-shareholding, pyramid shareholding is very common, so that the non-operating assets is a huge number. They can be half of the operating profit. So with these companies, you really need to set up something different to value the non-operating assets. For instance, one KGW model for the operating assets, and another 3 KGW model for each one of the non-operating assets, if they are significant. Depending on your needs, you probably will need a detailed model to value some non-operating assets. And okay, the revenue in your model, you actually have the choices of forecasting the revenue. We usually forecast a revenue growth in the coming 5 years and calculate a forecasted revenue number. Alternatively, you might forecast a margin, and also you have the option of forecasting an operating EBITDA or EBITDA. So you might have these options in your forecasting model. Ask yourself which is more appropriate for Woolworths. Do I have confidence of forecasting the margin? Do I have confidence forecasting the revenue growth? Which model is better? And which model will be like more resilient to uncertainties in the future? The key value drivers, I have discussed some of the concepts of Woolies. We probably try to discuss more details of the business and the understanding of the competitive advantage of Woolies next week and next week workshop. Here I give you some hints, the questions you probably want to ask yourself before you start forecasting or modeling Woolworths. Okay, we still have a few more minutes so that we can have a look at the example. Okay, so for ABC, that's a construction material company. Obviously, if you look at the revenue forecast, they divided the business, ABC, into 3 business units. Cement business, cement, lime business, and the other one, concrete. So they forecasted in 3 different business units in a way of volume and revenue. So they did forecast. They tried to associate the volume growth in that particular business units, like the cement, and relate that to the revenue forecast of the company. So that's one way of constructing your forecasting model. There are a lot of other options we're going to discuss next week. But for you, for now, you need to decide, okay, are these going to be the major parameters you're going to forecast? For instance, for Woolies, is it possible to forecast a volume or price? Is it possible to forecast a volume or price in order to generate a revenue forecast? What's the volume? Like the number of eggs Woolies sell every month? Or the number of bottles of wines they sell every month? Is it possible to forecast the volume for Woolies? No. For ABC, it's possible. You might forecast the volume and price. What are the other examples that you may forecast the volume? That you can do a simply multiply, you can get the revenue. Toll road, right? So you can forecast the traffic, the number of vehicles are going to use this toll road. You know the average, weighted average of toll you're going to charge for each vehicle. You can forecast a revenue. What else? Some other companies that rely on traffic. Yes, excellent. Airport. If you're going to forecast the revenue of Sydney Airport or the second airport of Sydney, you might use traffic. And even for companies like Qantas, you might forecast the passengers, the trip. They forecast actually in trip. The unit is trip. And also they forecast the freight. So with this business, it's possible to forecast volume, price, and they're going to feed into your forecast model of revenue. But for Woolies, we're going to try something new. So what's your impression or initial ideas of forecasting for Woolies? So volume, price excluded, and what are the other options? Just get some ideas, just say it. It doesn't have to be correct or meaningful. What's your guess? How are you going to forecast for Woolies? The number of stores? Good. Yes, they are retail stores. The food retailing, Australian food retailing is the core business. They do have some business plans of opening up some food retail stores, which are quite different from the traditional suburban big stores. So that may be a growth area for Woolies. So you may forecast, have some understanding of their new store opening plan, and what else for Woolies? I cannot hear that. Sorry? Can you please be louder? The membership card. The reward, you mean the reward program? Okay. It's only a small portion of the retailing business. I mean, for the retail, especially for the core business. So with these suggestions of, sorry, I should bring this up so that you have some better guidelines. I'll give you some suggestions. With the business of Woolies, okay, initially I just want to forecast by different business units. Food retailing, especially Australian food retailing, Big W, hotel, liquor, sorry. We'll just stick with these 4 business units. Okay, for revenue growth, are they going to experience similar percentage growth in the next 5 years? Retail. So you might think, okay, for food retailing, what's the current growth rate? Is this business model built in a way to sustain this level of revenue growth? They did reasonably well in 2017, and also in the first half of 2018 as well. So ask yourself, is this revenue growth sustainable in the next 5 years, given the action of other competitors in the market? So it's like it's a dynamic industry. It's not static. Ask yourself, the other important business unit, for instance, liquor. Is this revenue growth sustainable? Okay, that's the way you forecast by revenue growth rate, and you ask this question to yourself. Another approach to forecast is by looking at the profit margin of the company. That's even a better measure of the company's competitive advantage in the industry. If you look at the past 5 years, the profit margin of food retailing at this level, ask yourself, is this sustainable in the next 5 years? And what your ideas of how this margin is going to change given the industry dynamics in the next 5 years. And then when you have an idea of the profit margin, for instance, you believe after demerge, Coles will be put in a much stronger position to compete in the packaged food industry and in the fresh food market, and Woolies will face a pressure of its profit margin, and how that pressure will squeeze its margin. That's how you can build your understanding of the business, your understanding of the industry into the forecast model. So for Woolies, you have all of these options. You make your choice in your model. Time horizon is not a choice for the KGW model, and it's appropriate for Woolies. You do detailed forecasting for the next 5 years, and we do have some information about the prospect of food retailing industry. And for the next 10 years, you do key driver forecast only, like the revenue growth, the capex, the key parameters into the model, and then estimate the continuing value for year 16 and beyond. For assignment 1, you probably don't want to worry too much about sensitivity and scenario analysis, but keep this in mind, that when you build your model, it will be easier or possible for you in the future to change some of the parameters so that you can generate another set of valuation for the company easily. For instance, the revenue growth. So instead of importing hard number into the operating revenue growth rate here, you may want to link the cells to another spreadsheet, like what they have done in this assignment of an overall revenue growth rate. So the forecast drivers, the revenue growth, will be linked to a number of the cells of your revenue forecast model, and these numbers are from your forecasting of different business units or geographic business units. And for any one of the business units, you make the model easy to enter forecast. Here they just use a simple moving average. You see, it's flat forecast. It's quite simple, naive forecast for that business unit. But you probably want to run more complicated model and link to the revenue to some business drivers so that this will fit into the overall business revenue and later on fit into the forecast drivers. For each of these forecasts, you have a model itself. So all of these cells are going to be linked and feed into the valuation. And in the future, you go to change any one of these numbers, and the whole valuation will be updated so that you have another scenario in terms of valuation. Scenario means that this is your mid-average estimate. What about the economy does not turn out to be what you would expect? So like a possibility of recession, the possibility of another resource boom if we're extremely lucky. So you might build these scenarios into your valuation model by changing the revenue forecast. And also for sensitivity analysis. If you just got to change some of these key parameters, you got to observe your valuation. You will see the change of valuation and the key performance ratios here. If they just a very small change in one of the key parameters, if you observe a significant change of performance measures and the valuation, that means that parameter is very risky. You probably want to spend more time to make it as better measure as possible. So that's why we run sensitivity and scenario analysis. You might build your model in a way to facilitate future sensitivity and scenario analysis. Okay, let's have 5 minutes break. Then we go to discuss the ROIC and NOPLAT estimation. The home improvement.
Yeah. So basically, and then in another, they have all the cash flows from masters, and it's really tiny in the end. It's only like 0.9 million. So I thought maybe I should be more about it. But they also sold it for $500 million, number to subtract from the revenue, the cash flow, or what they sold it for?
Not the cash flow.
Not the cash flow.
Not the cash flow.
So I don't worry about the cash flow. I just worry about the price they sold it for.
Profit. Profit. Only the profit will go into the P&L.
Only the
Profit. Yeah.
So what is the difference between the amount they sold it for and the profit?
Okay. So as a business unit, you can consider this as one piece of asset. Okay. When you sell it for $500 million, it doesn't mean that you make $500 million profit, because in the past years, you just put a lot of investment in it, and it probably has cost you more than $500 million.
So
You don't make a profit, right? Especially when this business has been disposed, it's reported as a profit on the P&L. It's not the cash flow; it's a profit. So its profit is just the money they receive, deduct the cost of that piece of
So
asset.
it is not in the revenues, yeah? Alright, so it is in the revenues and it also in the profits.
It's in the profit. So if you read P&L, it's included in the net profit, but not part of the top line revenue, because it's disposed units. That's why they call it discontinued operation.
Okay.
Any results from this discontinued operation will be separated from other existing assets.
So I couldn't find the profit amount, I just could find the amount they sold it for. Maybe I didn't understand.
I have.
It's really hard to read that.
Yes, I have the annual report, I think.
So it's on page 100.
54, that's the P&L.
Yeah, it's a note. It's a note.
That profit loss from discontinued operation after tax, that what you're going to input into KGW model as the non-operating income.
Okay, understood. Second question with the petrol station, because they haven't sold it yet, I also have to subtract all the revenues from petrol station. Yeah?
Okay, so for 2017, it was like sort of assets held for sale. Now the sale agreement was scrapped. So you have the choice, like including the petrol over there. It's still existing assets, it's ongoing, but they are very clear. We're actively looking for a potential buyer that might be still an operating asset. So you have the choice of including this as operating or non-operating. It's your choice.
Yeah, but I subtracted from revenues.
That's no problem at all.
And also from expenses. Yeah, I subtract from
If you find the data.
If I find the data, okay.
Yes.
I'm just worried about the discrepancies. What if I don't subtract from expenses, but I did from revenues?
And another consideration here is the trade-off. What's the size of that business? If you look at the revenue, the overall revenue, that's very well over $55 billion. What's the revenue of the petrol station?
I don't know.
A few
If
billion.
it's very...
Maybe only
Yeah, I think it's 1 billion.
maybe 8% of the overall revenue.
Is it large?
No.
No, it's small.
No. So that's why you have to think about the trade-off. Is it worthwhile to separate from other revenue, or do you have the data? You have to consider this. If that business unit is like $20 billion,
Yeah, okay. But they don't have
you have to be very careful about that, to include it in there or make it a non-operating. No worries. Yes.
I actually wrote to you about the competition, but I can talk to you later.
The portfolio competition?
The M&A competition.
Ah, okay. Okay. Yeah.
I'll talk to you after the lecture.
Yes, that's better. Yeah, thank you. Yes.
One people ask,
What do you mean? That's going to be very risky. ROIC is a ratio. And the calculation of ROIC is from NOPLAT over invested capital. Both variables are sort of quite dirty measure of the company that mix up the accounting items and the cash flow. So on top of that KGW model, you made ROIC forecast. It gives you additional information, additional insights into the company's performance given this competitive advantage, how the industry is going to evolve in the next 5 years. But we do not forecast the ROIC to get the NOPLAT and the invested capital number. We forecast, the forecasting, we mean we start from the basic line items. But even if you have the concept, okay, the revenue growth is driving the company's ROIC, you start from forecasting the revenue. You don't forecast the ROIC. We use ROIC in a way to do model consistency check and for the diagnosis to see, okay, if I have this trend, historical trend of ROIC, and I have this forecasted ROIC, are they consistent? Is this consistent with the company's competitive advantage in the industry? So that's how we use ROIC. We do not forecast itself, that ratio. It's too risky. No problem. Yes?
When we split the company up, can we split it into parts which have more than one division? So just for example, this one does the food and the petrol together, and then they do Big W and other consumer retail, and then hotels. Could we do it like that as well? It doesn't.
Yes, it does, because that if you look at the nature of the business, they are quite resilient.
Yeah.
And that Big W, these consumer electronics, they are discretionary, and that's another business.
The hotels, yeah.
Different nature. You can do it.
You can do it like that.
Very
Okay.
good.
And the other thing was, when we're doing the forecasting, so we'd have to do like a fair bit on like what the future competition is going to look like. But how much research do we have to do on top? Because I'm just worried that we'll end up doing like a whole nother research on, say, Coles, for example. So how much research would we have to do into like the forecasting of Coles' future to compare it to Woolworths? Do we need to do a lot of that?
If you look at the water week 4, I have the lecture slides and some materials available already, and also you can read the textbook of forecasting to understand what we mean by industry research, and you try to understand the bargaining power of the major players in the industry for each of your business units. You classify, and then try to build this understanding into your forecast model.
So for Coles, for example, because they just demerged, would you have to look into like what their expected future profit, like what their future's going to look like?
Because now it's still part of Wesfarmers, and you read the annual report of Wesfarmers and find out the strategies in place now for Coles.
Okay, yeah. Okay, thanks. Thank you.
No problem. Okay, in the next hour, we're going to have a look at the how we're going to calculate the important valuation ratio, ROIC. That's the single most important valuation ratio we're going to look at in the course, and we're going to spend a lot of time studying ROIC and investigating ROIC of Woolies in your assignment as well. We're going to compare Woolies with Coles, if we can calculate that, with other players in the market, compare with the industry average. We're going to have a look at the trend, the change of ROIC, and the ROIC excluding goodwill, including goodwill. So we're really going to spend a lot of time studying ROIC. It's so important for valuation, but it's got its own inherent shortcomings as well. So ROIC is return on invested capital. So we mathematically is calculated as NOPLAT divided by invested capital, and both measures are for operating of the company. So still the concepts, we strip out all of the non-operating assets, non-operating income or expenses from NOPLAT, and we strip out all of the non-operating capital investment in the denominator. So this ratio is purely for the operating assets of the company, and it tells us the performance of the company, its core business performance. So what's NOPLAT? It's net operating profit less adjusted tax. So it's an after-tax profit measure. But it's not EBITDA, it's not EBITDA, and it's not operating profit you can read from the annual report. It's a measure for valuation analysts. We try to use KGW model to generate as better as possible valuation measures to represent the company's underlying performance. So that's NOPLAT. It's different from NPAT as well. If you have a look at data analysis, the Morningstar analyst and also Macquarie Research and several other stockbrokers, the analysts that produce NPAT, that's normalized profit after tax, which is different from our NOPLAT. Since the KGW model was designed and used for the management consulting companies, so it delves very much into the underlying performance of the company instead of generating just simply an operating profit forecast. We're going to talk about NPAT later in the second half of the semester. So for KGW model, we calculate net operating profit less adjusted tax divided by the invested capital in operation. And the difference of ROIC and weighted average cost of capital is a measure of positive, zero, or negative economic profit. So it does provide additional information. If you look at KGW model, if the economic profit is positive or negative or zero in the valuation summary page. So estimating ROIC, so we still focus on calculating the ROIC of operating assets only. With the non-operating assets, they tend to be quite small, trivial, and we don't really spend too much time on the non-operating assets. So this is what we care about, the performance analysis of the company. One important principle of calculating ROIC is the consistency of your measure of profit and invested capital. So when you calculate the profit from operations, only income and expenses from the operating assets should be included. So profit from disposing of property or office building, profit from disposing of business units are not going to be included in your NOPLAT. And invested capital as well, only investment in operating assets. For Woolies, it's food retailing, liquor, hotel, and Big W. These assets, not all, any of the equity investment, or they have investment as an equity, like for instance, 20% in another company. If they decide it's important to have some investment in one of their suppliers, that's usually the case for the manufacturing firms. That investment is recorded as non-operating assets. So that investment, that's part of the funds provided by capital providers, is not going to be included in the ROIC calculation. So when we calculate ROIC, consistency is very important in terms of giving you a concise, accurate representation of the company's underlying performance. The invested capital can be calculated or understood from different perspectives. One perspective is from the capital providers. That's the first line of the equation, total funds invested for the company. The debt, some debt holders, they provide funds in the form of corporate bonds and bank loans, and in the form of equity, the shareholders. And for Australian shareholders, it's quite simple. We only have like the ordinary shares. But for some other countries, like especially the Asian countries, European countries, South American countries, they have non-voting shares, voting shares, Class A, Class B, Class H, Class W. They have different classes of shares. They carry different amount of cash flow rights and voting rights. And make sure you only include cash flow rights, equities here. They have a claim over the assets, not really the voting shares. That's a little bit complication from the capital providers. And other claims might be in the form of capitalized operating lease. So operating lease is usually treated as debt because it's capital commitment. You have to pay for these, for instance, $98 million in the next 12 months, so that you have the user right of this retail shop. That's crucial for you to undertake your business. So it's usually treated, operating lease is usually treated as debt-like. With all of these claims, they are the funds provided by capital providers. That's the total funds the company receives in their operation. Another perspective of understanding the company's operation is from the assets. You look at why does the asset always equal to liability plus equity, by the way? Because the assets are financed by the equity holders and the debt holders. So now we can have a look at the asset, the left-hand side of your balance sheet. So with all of your assets, you have non-operating assets, the equity investment in another company, and all your operations. That's the invested capital, what we care a lot in calculating the ROIC, invested capital. So to calculate the invested capital, we may use this equation, the sum of all of the capital provided by various capital providers minus the non-operating assets. That's one way to calculate the invested capital. We're going to have a look at a numerical example later. So the invested capital should be adjusted when you calculate ROIC for your operation for excess cash and marketable securities. They are non-operating assets. And goodwill, that's particularly important for companies that have been involved in merger acquisition in the past. They have a huge number of goodwill. It's recorded as an asset item on their balance sheet. But in most cases, if you see a large number of goodwill, analysts will try to calculate ROIC by including this goodwill and excluding this goodwill, because this is not actually something you can have a picture of. It's just exists on the book. It's not a factory, it's not a piece of equipment, it's not even a patent. So with goodwill, the valuation of goodwill is controversial, and when we try to do the valuation or performance measure like ROIC, sometimes we try to strict goodwill from its invested capital. It's on the balance sheet. It's financed by one of the capital providers. The intangible assets, if it's substantial, for instance, capitalized R&D, and sometimes some companies will capitalize their advertising expense, we still produce additional ROIC measures, including the intangible assets, excluding the intangible assets, to give you a better understanding of the company's performance in terms of ROIC. Capitalized lease, for now, you just should have some basic understanding that operating lease can be a substantial addition to the invested capital. On the P&L, the accountant record operating lease as an expense. It's going to be deducted from the operating profit. But for valuation analysts, we understand that for Woolies, although they do pay millions of dollars every year as operating lease for the shop, of their food retailing, or for their liquor, we understand that this is substantial capital investment because you do expect the revenue to come through in the next 5 or 10, even 40 years. If you go to read the details of their operating lease, some of the lease can last for 40 years. So it should be considered as capital investment for valuation purpose. So the invested capital, when you calculate ROIC, should include this increased capital investment. Or in other words, if you're going to capitalize the operating lease, you're going to increase the invested capital, underlying invested capital of Woolies, and there will be a reduction of its operating expense because the capitalized operating lease is going to be stripped out of the operating expense. Only the interest will be included in here. So after capitalizing operating lease, it's very likely you're going to have a higher NOPLAT and larger invested capital. The end result, we don't know. You'll find out when you do the capitalization of the operating lease for Woolies. It's called financial lease because it's not operating. So for financial lease, the ownership does change. It's going to be capitalized already on P&L. But only for operating lease, it only shows up in the P&L, not the balance sheet. That's why, for valuation purpose, we want to capitalize the operating lease. This is a simple numerical example of calculation of the invested capital. So on the left, you have the accountant's balance sheet. So that's probably you're going to find with a lot of listed companies. They have this inventory, net PPE, equity investment, that's the ownership in other companies, and total assets, and with the liability and the equity, the funding side of the balance sheet, accounts payable, that's working capital, interest-bearing debt, that can be corporate bond or bank loan, and common stock from shareholders and retained earnings. So they balance the assets and the source of the funds to invest in these assets. For valuation performance analysis, when we calculate ROIC, especially the invested capital for the company, we start from the operating assets of the company. So look at the assets on this P&L. So inventory is working capital, and accounts payable, that's another working capital. So we do a net of this working capital, have a net operating working capital of 75. And then we have look at the fixed assets, that's net PPE. It's simple. There's no intangible assets. So with the invested capital, the operation, 425. That's how you make out to read the company's annual report, get the data you need to calculate your invested capital for your operation. Non-operating assets are valued separately, and adding these non-operating assets, operating assets plus non-operating assets, you have the total funds invested of 450. These $450 million are provided by debt holders, shareholders, and retained earnings of the company. So that's the bottom part is only a reconciliation of have a look at the source of the fund, how the assets are financed. So it's clear that 425 are financed operating assets and $25 million of non-operating assets financed by all of the capital providers. So in your KGW model, we focus on this part. That 425 will feed into the results spreadsheet and the valuation summary spreadsheet. And later on, you're going to generate more ratios or graphs to study the invested capital change and the ROIC change. NOPLAT is the taxed operating profit. It's different from the operating profit in quotation mark from the accountant's P&L. And also it's different from free cash flow as well, because the way how we calculate the NOPLAT, it's for valuation purpose, and we believe it provides a better measure of the company's performance. So it's net operating profit. So only income and expenses of the operating assets should be included in the calculation. We're going to strip out all of the financing expenses like interest expense. We're going to strip out all of the profit or loss from non-operating operations like disposing assets, disposing equipment, disposing business units, or one-time charges like restructuring charges. So when you go to find the exact numbers from the company's annual report, you will have this EBITDA. It's in another way of operating profit. It's EBITDA. So it's earnings before interest, tax, and amortization. So it does include depreciation in EBITDA. And that's our measure, the base measure of our NOPLAT. So NOPLAT, that's why I say NOPLAT is a mixture of operating profit, accounting item, and the cash flow. We do include depreciation. It's not like free cash flow. Free cash flow does not include the non-cash expense items. But we believe there's a good reason that we use NOPLAT in our performance analysis, in the sense that, okay, we do not give out any cash in our operation for the depreciation. It's a non-cash charge on the P&L. But when we make the capital investment, we do expect, okay, the upfront capital investment of $10 billion, they're going to generate income and incur expenses in the operation in the coming years. There's a definite life of the assets or definite life of forecasting for the benefits of making this capital investment. So the depreciation charge is like a dispersion, an allocation of how much we're going to spend part of the capital investment in this year so that we can generate this amount of revenue. So this is a good reason that we use NOPLAT in the profit calculation or ROIC calculation. It roughly is calculated from EBITDA deduct the 30% in Australian context, 30% times the EBITDA, that will be the tax you're going to take out of EBITDA, and you get the EBIT, that's earning before interest and tax. That will be net operating earning after tax. The tax here is quite complicated and tricky issue. It's even trickier in the US because in the US, companies have federal tax, state tax, and they have different tax rates for dividends income, and they have, that's the ordinary income, they have different tax rates for capital gains. So calculating tax for US companies is even more complicated, and the tax rate on capital gains and dividends, they change. Over different years, the rate can change. But for Australian companies, it's just flat, 30%. So we might just consider this. 30% times EBITDA will be the tax liability you're going to pay. The tax treatment in the KGW model is actually based on the actual tax the company is liable to pay, the cash flow, and adjusted for the tax on non-operating items and on the capitalized operating leases. If you look at the tax statement of Woolies, it runs through several pages. So you will see there will be tax liability, tax assets, and sometimes companies may have like this tax carried forward from previous years, tax losses, a lot of things associated with tax. But for valuation purpose, all of these different representations of tax liability or assets are the results of the past activity of the company. Sometimes because of the changing from one accounting standard to another, sometimes because of the these special tax rulings by ATO, and some deferred tax liabilities of some investment in foreign countries. So it can be quite complicated, but for valuation purpose, we only care about the tax that's going to be deducted from the earnings attributable to capital providers. That's why in KGW, we use a more straightforward method calculated in this way. It's not actually the tax booked by the accountant on the P&L. I doubt this one is not working again. We may have lost the recording again. Okay. Anyway, we're going to discuss some the specific treatments in terms of tax and capitalized operating lease on Wednesday in more details. So the calculation of NOPLAT. On the left, you have the accountant's P&L. So revenue, operating cost, not necessarily operating for us, and depreciation, and operating profit. Interest expense, non-operating income, and earning before tax, 264. So for the KGW model, it tends to extract useful information to calculate NOPLAT, its preferred measure of operating profit. It's done in a way like operating revenue only, and operating cost only, and deduct the depreciation of the operating assets only. And you have the operating profit. It's a coincidence that is the same as the operating profit reported by the accountant. For most of the companies you're going to value with your KGW model, they're going to be different. And operating tax, we just do a simple calculation of, this example is 25%. It's 30% in Australia. There's effective tax rate can be a little bit lower than 30% because of the tax offset, tax liabilities, the tax credits they accumulated over the past years. So that's why there's a flat rate of 25%. And the no flat is 210. That's the operation, the results from the operation. And the non-operating assets, that's the after-tax result from the non-operating operation is 3. That's 4 minus the applicable tax of 25%. That gives you 3 after-tax result from the non-operating operation. And the total income, total profit attributable to all investors, 213 here. So the bottom is the bottom part of the table is a reconciliation of how you may understand the 213 of total profit attributable to all investors of the company. If the company has capitalized operating leases, you're going to make adjustment of the operating cost. That will be a reduction of operating cost and increase of depreciation because you're going to capitalize the operating lease, and that's an increase of capital investment, or in other words, you will have higher depreciation charges on your P&L. So that's a simple example of calculating NOPLAT. With the ROIC, we have these practical concerns that the main concern is that when we calculate the invested capital, it's not the actual cash we receive from capital providers because it got the claims of, for instance, from the employees, from the employee defined benefits, pension funds, or sometimes it might include the capitalized operating lease. It's another form of debt-like claim. So it's more like a mixture of accounting items and commitment. So it's like a product by the analyst that we try to devise to better reflect our understanding of the business. It's not reported by the accountants, like return on asset. It's not a clean measure like return on equity as well. So for return on equity, you just use the operating profit divided by the equity. So that gives you a return for every dollar of equity investment. But for ROIC, it does provide additional information of the company's underlying performance, especially when we capitalize the operating lease. That represents the true nature, the true amount of capital investment of the company so that it is able to conduct its business, for instance, Woolies and Qantas, these companies. The level of ROIC is often especially for people who start doing valuation, can be overused. So ROIC is a measure that's more useful when you look at the trend, and when you compare the ROIC of the company with its comparable companies, comparable competitors, or industry average. But looking at the ratio itself, it can be misleading because it does not represent a return for shareholders. Return on equity is the better measure. So it's more like a measure to tell you about the underlying performance instead of a return measure for shareholders. But it's very important measure when we look at our overall valuation model. So we still have time. Let's have a look at the example. This model is why I say it's maybe only, I'll give it a pass grade, because it does not have any diagnosis chart or graphs to show the trend of ROIC. all the changes of ROIC over years, or compare the ROIC of ABC to its industry average or to its competitor in the market. If you look at the model, it's so simple, and there's no model diagnosis at all. And if I try to identify if there's any problem with its forecasting, it's almost doesn't change, because when they do the revenue forecast in the forecasting model, they used a constant model to forecast each of the business units. That's why they generate such a stable ROIC, and they do not include any analysis of ROIC. In assignment 1, I really want to see you to investigate more of the ROIC so that you have some better ideas. Is this level of ROIC, excluding goodwill, including goodwill, sustainable, feasible for the company, given the industry dynamics in the next 5 years? And it's also, because this, they use a very straight and simple forecasting model, it does not change much. If you look at other examples on water, some past assignment, you won't have look at a change of the ROIC. And also, by the way, in the assignment folder, you have past example of students' valuation model. These are high distinction assignments. That's a good example of forecasting and constructing model. I use this one only for its simple structure to show you in lecture. So ROIC is an important measure in model diagnosis. Don't overlook its use in our valuation process. Hopefully, in this week and next week, all of the groups will start building the model, entering the historical data into the model, and to get help, solve a problem. You're going to have lots of problems, lots of questions. First of all, try to solve the question yourself. On Wednesday workshop, I'm going to demonstrate where you might find useful information and how you might use the data, use the information provided by the accountants to put input into your KGW model. I'm going to discuss a few accounting items only. I'm going to leave the rest of it for you to crack. You're going to crack one problem after another. So my preference is you solve the problems within your group first. You come together, discuss the problem and the question, and if you cannot solve it, ask people around you. And if you still do not understand, ask me. Send an email or read the notes of the workshop. You might find answer or some guidelines from there. I'm going to collect the questions and try to answer them in workshop. If it's straightforward, I will give you a reply. If it's a quite complicated conceptual issue, I prefer you come to see me. Next week, we're going to have a look at the forecasting of revenue, CapEx, and other important line items, and have a discussion of model integrity, and have a look at the performance analysis of company as well. I'll try to associate the industry analysis to Woolies as well. This week, we have the workshop to discuss how you might understand the financial statement of Woolies, to use that to enter into your KGW model. The notes are already on water, so if you have already started working on the model, read the notes through, and it may solve some of your questions. And Wednesday is also the cutoff time for the first round of group formation. And if you do not sign up to an assignment group, I'm going to allocate you randomly on Thursday or Friday. You'll get my email about the group allocation. Next week, we're going to have the first quiz, week 4. So the first quiz will cover the lecture and tutorial for the first 2 weeks. For the first 3 weeks. So the basic understanding principle of value creation, the simple process of enterprise DCF valuation, the major inputs into the valuation model. My aim is to have a different quiz paper for each tutorial. So I don't want you to release the questions to your friends in other tutorial. It doesn't help them at all. And it's going to make your quiz results not very good if you compare with your friends who already got your information. So we just try to make the quiz valuable experience for you to practice writing simple written questions, get yourself prepared for the final exam, and test yourself of the basic understanding of valuation. I'm going to put only the very basic, very straightforward questions into the quiz. Closed book quiz, no notes or any sort of formula sheets will be allowed in the quiz. And it's formal examination as well. No use of electronic devices at all. And 15 minutes. Yep. Yep, calculation. There will be calculations. Okay, I think I have covered most of the topics, and I still have 5 more minutes. I'd like to show you some of the other valuation models I have. This valuation model is available on Water. So if you're interested, you might search the name Lampholm and Sloan. There's a book, Security Valuation and Analysis. The valuation model I used to work with was based on this academic developed model. Compared with KGW model, it's much simpler to work with. It requires less inputs. Of course, it's not as rich as KGW model, but it's still useful, especially for students who are very keen investing in Australian stock market. If you hold a portfolio of 12 Australian listed companies, you may use this model very more efficiently than the KGW model. You might go to data analysis, download the Morningstar Analyst financial reports, and link very easily. You can link this model to the Morningstar financial statement to generate a quick and dirty valuation of the companies of your interest. But the ideas of valuation is still the same. Discounted cash flow, still the old model itself. You may have a look. There's another valuation model by academic. It's by Damodara. He's an academic, like the top expert in valuation, and he has stopped writing for publication. He's very dedicated to his online resources of valuation, the comments of the listed companies on the topics of valuation. If you search Damodara, have a look at the online resources, you will find a rich source of tools, analysis piece, and a lot of information about valuation. It will enrich your study, especially for students who are keen to work as an equity analyst in the future, or who are very active participating in the CFA Research Challenge or the Merger Acquisition Challenge. So this can be additional resources to give you different perspectives of valuation. Still, it's very much like the other academic developed valuation model. It's not as rich as KGW model to give you so much ratios, measures of companies' underlying performance. The KGW model is designed in a way to indicate ways of improving the company valuation, improving the company's operational efficiency, because it's done by the management consulting firm. So these are the resources that you may have a look to just help you to get better ideas of the valuation models.